Good day, this is Shauna Casey, and welcome to this SOS educational webcast, The Whole Enchilada, Accounting for PSUs from Top to Bottom. Due to the large number of attendees, no conference call service is available for this webcast. The sound will broadcast through your computer speakers. However, if you wish to ask a question at any time during the presentation, please feel free to type it into the Questions and Answers panel of your GoToWebcast console, and we will do our best to answer them as they come in. Any questions that we don't get a chance to address during the webcast, we will follow up with afterwards in an email. This morning we sent an email with the link to the presentation materials to everyone that registered as of 10 a.m. Pacific this morning. You can also find the link to the materials under the Event Resources tab on your GoToWebcast console. This session will also be recorded, and we will send a link to the recording and materials in the next day or two. I hope that all of you are familiar with Stock and Option Solutions, or SOS as we are more commonly known. For those of you who are not, SOS is a leading stock administration, staffing, consulting, and outsourcing firm within the equity compensation marketplace. SOS provides interim and permanent placement, expert project resources, and total outsourcing solutions. To learn more, you can visit us online at www.sos-team.com or call us at 408-979-8700. Next, I'd like to introduce you to our speakers for today's session. We are pleased to have our own Bill Storey, Elizabeth Dodge of Equity Plan Solutions, and Michael Esposito of Solium on the panel today. Next is our standard disclaimer slide. We'd like to remind you to consult your own advisors before making any changes. As I mentioned, the materials are available on our website, and here again is the link. Thank you all for joining us today, and with that, I'll turn this presentation over to Elizabeth, who will introduce our topic and cover the agenda. Thank you.
Thank you, Shauna. All right, so we're going to start off. Here's our recipe book. We're going to start off with how to make an enchilada, how to account for an RSU. We're going to start off with defining what is an PSU. What is a PSU, what are performance awards. We'll give you a quick overview of the different types, market-based versus performance-based, what that means in terms of accounting attributes because it's very different. Attribution or recognition of expense next. Then we'll get into tax accounting and then diluted EPS, everybody's favorite topic, and then more disclosure. We have some sample disclosure items, some sample disclosures from various companies' 10Ks that we'll go through. I do want to call out that at the end of the material slides we have some information we're not going to get to today, but it is additional information for you to have access to. There are even some performance option disclosures in there. It was a little off topic, but we wanted to give you as much information as we could. So with that, we're going to move right into the definition. What is the definition of a performance instrument or a performance equity instrument? It's basically anything, right? It can be oh, it looks like someone's having trouble hearing audio. I just want to do a sound check with Mike and Bill. Can you hear me okay?
Bill is here. I can hear you just fine.
Okay, so we think it's not me. It may be your internet connection if we're having trouble hearing stuff, but Shauna will answer those questions. Sorry. All right. So what is it? It's any equity instrument. It can be an option. It can be an RSU. It can be an RSA. It can be a stock-settled SAR, a cash-settled SAR, and then on to that you tag some sort of metric or some sort of goal that must be met. And it used to be in the olden days that what that would mainly do is accelerate or decelerate the vesting. That was the way to avoid variable accounting in the olden days. But now mostly the performance criteria are revenue goals, relative TSR goals, and we'll talk more about that in a little bit. But take any flavor of grant and attach some sort of other criteria that needs to be satisfied other than staying employed. Now, that said, you do also need to stay employed. I've not seen, at least in the recent past, any performance grants that didn't also have a time requirement. So not only do you have to meet target A and target B and target C, but you have to stay employed through this date, through this date, through this date, most of the time. And again, could be options, any flavor of equity instrument. But today we are going to talk about PSUs, aka restricted stock units with performance criteria on top of that, because those are the instruments we see most commonly. And based on survey data, they are the most frequently granted. Okay, so here are the two main types we see. Again, there are lots of different.
Elizabeth, I'm sorry to interrupt, but it does look like there is an audio issue, which we have not experienced before. Okay. So, as I did mention, this session is recorded, and we will send that out. I'm going to say just go ahead and continue while I try to figure that out on the back end.
Okay. All right. Sorry about that, everyone. I haven't
experienced it before.
Yeah. At least Bill and I do show us as being on the air, so.
Right, because I'm also logged in as an attendee, which I always do, and I do not hear you.
That's unfortunate.
So that is unfortunate.
All right. Well, we'll keep going. We'll make a recording, and we'll send out the recording. Well, no one can hear us. Now the pressure's off, guys.
You gotta love technology, right?
Yep. Okay, the two main forms that we see most frequently, the criteria, and very, very different accounting for these two different types, are a market-based award and performance-based awards. And when we say market-based, we mean really anything related to stock price. Right, so it could be, and we'll go through some examples, your stock price hits X, or it's a total shareholder return metric, or some other form like that. And then I'm going to talk about the accounting as soon as I talk about the performance-based awards. Performance-based are anything that is not market-based. So it could be a revenue target, an EBITDA target, a sales goal, a quality goal, anything that's not related to stock price, some internal, usually internal financial metric. Now the accounting for market-based, very, very different. You need to, with a market-based award, you're actually required to use some sort of sophisticated option pricing model that will embed the possibility of success at the goal, of hitting that stock price, or the possibility of failure. It needs to embed that possibility, that probability into the actual fair value. So to do that, you use something like a Monte Carlo simulation, and that's created on grant date, and you do not adjust that. You do not mark up and not mark down. It's not variable accounting. There's no motion. You just accrue that over the requisite service period. And because, again, the probability of failing to achieve the goal is embedded in that fair value, if the goal isn't met, the expense is not reversed. Unlike time-based options, if you don't hit the vesting, the expense is reversed, right? If you don't get the RSU payout because you terminated, the expense is reversed. And it is a little bit like options and RSUs, time-based, in that if you don't meet the service requirement, the expense is reversed. But a failure to achieve the market-based metric, your expense would be retained, not reversed. Okay, so for performance-based, extremely different. For PSUs, the fair value is just the market value on the grant date. Very simple, just like a regular RSU. But the expense is adjusted up and down, and we'll have some examples in a minute, each reporting period based on the probable payout estimated as of the reporting period end date. So if you think it's going to be 80%, you book expense based on 80%. If you think it's going to be 120%, you book the expense, and you do a cumulative catch-up each period as that estimate changes. On these, if you don't meet if you don't achieve the goal, the expense is reversed because the possibility of not achieving the goal is not part of that market value, that fair value on grant date. Again, failure to meet the service requirement, the expense would be reversed. And we'll talk more about this in a minute, but if it were an event-based goal like an IPO, like a merger, these will vest when we go public, this will vest when the merger closes, this will vest when our drug is approved by the FDA, no expense is recognized for those until the event actually occurs. Not when it's probable of occurring, when it occurs. And Mike, I know you were going to chime in on this slide a bit.
Sure, and I'm just going to interrupt. It looks like we're fine with audio. It looks like it could have been a flash player problem on the user end. So everyone can hear us, and we're good to go. Thank you very much.
Thank goodness. Now the pressure's back on.
Pressure's back on.
Great. So as you were saying, Elizabeth, what we can see here is certainly a vast difference in terms of how these performance criteria really bleed into the expensing side, the accounting side. And like you said, we are going to go into more detail and provide some examples of those. But if there's one slide that you take away from this webinar and kind of file away on your desktop anywhere, hang on to this one, because certainly from a service provider standpoint, this is the first kind of potential point of failure that we're really dependent on a user to be able to provide, right? Knowing the difference between a market-based and a performance-based, and being absolutely sure which of your, what your criteria maps to, is the first step to ensuring all those subsequent calculations on the accounting side and the deferred tax side, and how the adjustments are triggered, or if they're triggered, like you're saying, is really the first point that we really need to be sure on. So hang on to this slide, everyone, and make sure you can always circle back to this and kind of map or sync up your specific performance criteria to the different descriptions here.
Print it out and hang it on your cubicle wall. Just kidding. All right, Bill, you're going to take us through some examples of these different types of metrics?
Yes. So just to reiterate, here are some of the examples of metrics for market-based metrics. As Elizabeth noted, those include anything involving stock price, whether it's a particular stock price that must be met over a certain period of time, such as the share price closing at $30 for 30 consecutive trading days, or it can be total shareholder return, also known as TSR, another acronym to add to the book. TSR is basically the change in stock price over time plus any dividends if your company pays dividends. And that can be either a positive change or a negative change. And then this third point, dealing with peer company shareholder return, this is just comparing your company's shareholder return against the peer group. And in a volatile market, if everyone's down but your company's doing a little bit better than others, that could generate a potential payout for your participants. Likewise, if your stock is not doing as well as your peers, then you may not be entitled to a payout. So those are just some of the examples of market-based metrics. As it relates to performance-based metrics, as Elizabeth mentioned on the previous slide, these are company or individual metrics or milestones. They can be earnings per share, net income, or sales or revenues. If your company is going IPO, there might be an incentive for management to ensure that the IPO is successful. Likewise, if your company is going through a merger or an acquisition, comp committees may grant management and key employees an incentive to close the merger on time, as well as ensure that there's some type of transition after the merger closes during what's called an integration period. FASB ASC 718, which is the U.S. GAAP accounting rulebook for stock-based compensation, does include definitions of what's a market-based condition as well as what is a performance-based condition. And the appendix at the end of this slide deck includes those definitions.
Great. Thank you, Bill.
Anything else? Mm-hmm.
Nope, that's great. And we are going to move on and talk about attribution. So this is actually a point of confusion for a lot of companies. This is probably the second or third most common issue. I see people don't know about performance awards. Lots of you already do know about it. I know we'll be preaching to the choir, and for that we apologize. But we only get to choose straight line, which 99% of us are all using in our companies for options and restricted stock units. That is only for awards with only service conditions. The moment you tag any sort of performance criteria on to an award, whether it's a market-based criteria or a performance-based criteria, now your FIN 28 or your graded attribution is required. So this is a quote from the standard. Somebody asked me yesterday, what's that part of the standard that does blah, 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 blah? I'm like, oh, that was ASC 718-10-35-8. It used to be paragraph 42. I had those memorized. But this one is a good one to commit to memory, too, because your auditor will come in and say, what part of the standard is that? So just work on those numbers when you have nothing better to do. But you can see it's for an award with only service conditions you can choose. You can do graded attribution, what we would call multiple or FIN 28 or accelerated, and we'll talk more about when it might not be accelerated in a few minutes, or straight line. But that's only service-based conditions. Any performance criteria that requires that other kind of attribution. And there are lots of different terms for that kind of attribution. Some presentations, or practitioners will call it FIN 28, even though FIN 28 were superseded. But you just have to know that it means amortizing each tranche. And Bill is going to talk more about that in a little bit, but we'll get into that in a moment. The first thing we're going to cover, which is the most common mistake I see made in accounting for performance awards, is the service inception date. So this is a really common point of confusion because a lot of the time we have a service period that's from January 1st, 2017 to December 31st, 2017, for example. And so your grant may not occur until the middle of February, the middle of March, when everything gets together and all the stars align and the grant actually happens. Well, if that's the case, what's your service inception date? I've had plenty of company accounting personnel even write memos and say, oh, our service inception date was January 1st. And in fact, it's not. Generally speaking, it's not going to be the beginning of your performance period. It's going to be usually the date that the grant was made. It can be after the performance, after the grant date. Your service inception date, Bill's going to talk more about that in a minute, can be after your grant date, but it almost never is before your grant date. And here is a slide that is the actual language from the standard, which we're not going to spend any time in at all, but this is the part where it says, this is when you can do, I have a translation slide next, so it's going to break this down into hopefully a little more plain, simple English. But again, this is the part of the standard that says your service inception begin date can precede the award when, and now we're going to skip this slide, but you have the language in case you ever need it, when A, an award is authorized. So the translation for that is, has the grant been approved? Most of the time, yes, check. So far it looks like we're going to have a service inception date before our grant date. But wait. B, service begins before a mutual understanding of the key terms and conditions of a share-based payment award is reached. So your service began before your grant date. Most of the time for that, the scenario we just talked about, January 1st was when your service sort of began. They started working toward that 2017 goal. So check, yes. But C is where we run into, I don't see this ever happening. C1, this has to be either 1 or 2. Either one of these can be true and you would have a service inception before. Number 1 is the award's terms do not include a future service condition. So they could leave on the grant date and still take the award with them. I've never seen that in an award design. I'm sure they're out there, but it's not very common. Or 2, the award contains a market or performance condition that, if not met during the service period before the grant date and after the inception of the arrangement, will result in forfeiture of the award. So you have to meet the target between January 1st and February 15th in our example, or you're going to forfeit. Again, I've never seen that. So generally speaking, that was a long way around to come to, in general, you are going to see your service inception date for a lot of these awards happen on or after the grant date. And Bill is going to talk about why it might happen after the grant date. Oh, I'm sorry, Bill, you had more to say on that last slide. I'm going back.
Oh, no, you're fine. You're fine. You're okay.
Okay, so we'll go on and let Bill talk about service inception dates that are delayed till sometime after. And we'll have a pretty picture in a minute, too, if that helps. But for now, let's talk about the theory.
So, real quick, there's a question that came in that asked, what if the VCD, or the vest commencement date, is January 1st, 2017. Is that tied to the grant date, or is it tied to vesting?
Okay, so thank you for watching the questions, Bill. I should have been doing that. But if the vest commence date is 1/1/17, generally it's still the grant date, because those criteria that we just went through, having a vest commence date on 1/1/17 does not meet C1 or 2. It's not going to get, there is still a future, we'll go back to that slide for just a moment. There is still a future service condition most of the time. And number 2, the award's not going to be forfeited if you don't meet the goal before 2/15/17. So in that condition, and I do get that question a lot when you have a new hire, and I get this question for options even. You have a new hire and you start the vesting on the hire date, and then the grant date isn't to sometime later, it's still your service inception date is still your grant date. So, but let's talk about delayed service inception dates, and I'll watch questions for you for a little bit, Bill.
Thank you. So for delayed service inception date, this relates primarily to awards with multiple performance periods. So think of an award that was granted in February of 2017. and it has an annual revenue or an EBITDA metric that is for fiscal years 2017, 2018, and 2019. In this case, each metric is independent of the other one. They're not really dependent on each other. So even though the performance period is January 1 of each year, your service inception date may very well be the grant date, which is when the award is actually valued, or it could, in certain situations, be January 1st. However, keep in mind, you're still going to record the same amount of expense over the 3-year period. You just may have a catch-up during that first year, given the timing of when the award was granted. Now, if the targets are related to each other, or they're dependent, say, for example, that you have a metric where sales has to increase over a certain percentage from the previous year, then you have a situation where your service inception date and your performance period, all of those different dates, it's key to make sure you understand which date you're valuing the award and which date you're expensing the awards over. Those could very well be on the exact same date. And so you may have a tranche related to fiscal year 2019 that you start expensing on the date of grant because those metrics for that particular award are all dependent on each other. You need to meet one before you can meet the other one. If the goals are independent, you can value them all as of the grant date, and then you can expense them, as Elizabeth mentioned, and I think we have another slide coming up. You can expense them using the multiple approach or the graded approach for that specific performance period. It's all based on matching. I'm actually
going to take us to that next slide so that you can show that third graphic, that it's delayed service inception date. That helps, I think, crystallize what you're saying, Bill.
Yes. So as you can see, the third graph on the right is almost the exact same as the first graph. However, keep in mind the performance periods are independent of each other. If they were dependent on each other, you'd be in this middle graph where each tranche or each performance metric would be expensed from the date of grant, assuming, of course, the award is probable. And that's a key word that you may not be familiar with. Probable in the accounting sense is there's a likely percent chance of either 70% or higher that the metric will be met. If that is the case, the accounting gods tell you record the expense for that time frame. If it's not the case, it's considered improbable, therefore you don't have any expense. Mike,
and
Elizabeth?
We did get another question that I want to just, this relates back, this harks back to our discussion of what happens with event-based IPOs. So it looks like this, and we'll try and go quickly. It's a little bit of a complicated question, but basically she's saying that the shares will vest when the performance condition is based on the following. Vest when the company valuation exceeds XX million. However, the company valuation is defined of either of the following two events. One, the 409A total equity equals XX million, or the market cap at IPO equals XX million. So would that be event-based or not? I would, and I'm going to take that offline. I'll follow up with you offline, but I would argue that your 409A valuation is also not entirely within your control, that could still be considered an event-based transaction, right? Because generally you're going to have a third party come in and make an assessment and look at all the metrics about your company and look at the peer company out there and discount for illiquidity and blah, 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 all that fancy stuff. They are going to make a determination of what your company is worth, and that's almost I can't think of the right word at the moment, but it's almost as arbitrary. I won't say arbitrary, it's not quite the right word, but as an IPO or getting a drug approved by the FDA. It's outside of the company's control. You can do all the right things and be moving in the right direction, but there's still a whole lot of factors that you're not in complete control of. So I would argue that's also event-driven. But I will definitely follow up with you after and see if I can find you any examples or some more resources to help support that position. All right, and so we were, go ahead, Bill, sorry.
One more question real quick on this particular diagram. The person said, some clients think you can calculate fair value at the service inception date, or diagram number 3. Is that okay?
And I'll take that if you don't mind. It's not okay if all the terms and conditions are known. So if you know what your goal is, and it's independent, right, with diagram number 3, you still calculate your fair value on the grant date. If you don't know what the goal for tranche 2 is or tranche 3 is, then you can't calculate your fair value until you hit the beginning and those goals are defined. But if it is the terms and conditions of the award, including the performance metric, are set on the grant date, then that grant date is the date on which you must calculate your fair value. So thank you. Good question. All right. So this graphic, I think Bill's already covered most of it, but you can see a straight line, what we're all used to, amortized tranche by tranche. Graded is what we like to refer to as accelerated sometimes, or FIN 28, because we're going to start the expense for all, start the expense for all the tranches at the same time and recognize each of those over its service life. And the thing that people say, oh, well, that service life for that second tranche is only a year. No, it's not. They have to stay employed for 2 whole years to earn that tranche. So it really is a 2-year service period. So I think that FIN 28 or graded attribution makes a lot of sense. All right, let's see. And now we're moving on to some examples of the performance. Oh, wait, I'm skipping ahead. Mike is going to take us through an accounting example, right, Mike, from MarketBased?
Sure am, yep. So market-based performance is my absolute favorite thing to talk about. So let's take a look at the accounting side first.
Not that you're a geek at all, Mike. No.
Yeah, I promise we'll get to the even more exciting tax accounting stuff soon. But for now, previously, remember that's my favorite slide that I already told you guys to earmark, talked about the market-based and performance-based criteria. So let's just take a closer look at the market-based side specifically. So here's a great example. 100,000 target shares granted on date X, doesn't matter, when the stock price is $10, and it's vesting on a sliding scale based on a measurement a year later. And we can see here just a nice kind of example of looking at a stock price average. If it's less than 12, it can go $12. It can go anywhere from 0% all the way up to a 125% payout. So knowing that, the Monte Carlo simulation does its Plinko thing and spits out a fair value of $11. And remember, the thing to take away from that slide is that no matter what, if the payout ends up being that top tier, 125%, or if it ends up being 0, the expense is retained. So regardless of your plus or minus kind of performance shares, the expense is always going to be that 1.1 million in our case. That doesn't, that's only for the performance side. Though, of course, if an employee were to leave the company prior to that, in this case, January 1st, 2018 date, that would, of course, still trigger a forfeiture. So you would get the expense reversed for that. But again, positive or minus kind of performance impact on those shares does not end up hitting your expense at all, in this case for a market-based condition. So knowing that, why don't we take a look at the performance-based, where Bill can walk us through that.
One moment. I just want to go back and address this. Why on earth could the fair value be $11 when my stock price is $10? Which is something I learned fairly recently, right? It seems like with this possibility of failure embedded into the fair value of the award by the Monte Carlo simulation, well, I should get a discount. It shouldn't be a $10. It shouldn't be based on the market value. It certainly shouldn't be greater than the market value. I should be amortizing $8 or $7. And the reason it can be higher is, A, you have a potential payout of 125% there, right? You might get more value than is being reflected. And it's dependent on the likelihood and the volatility and the path-dependent scenarios and blah, blah, blah. The other time that can happen, even if you only have 100% payout, is let's say you don't set your goal until the 15th of February, the 15th of March. You've already started the year performance period and your stock price is already up. It's like placing bets when the game has already started, right? That will actually often result in a higher fair value as well. So those are 2 little valuation consultant tips I learned from my valuation consultant friends this year. So with that, yes, I'm sorry to interrupt. Let's go on to Bill's going to take us through our performance-based example. And there are 2 slides for this now, Bill.
Thank you. So for this accounting example, we have the same 100,000 PSUs that were granted. on January 1st, 2017, and the stock price fair market value is $10. The fair market value is also the same as fair value in this case, so you have $1 million worth of total expense or total fair value. The vesting is met on January 1st, 2018, after certification of achievement. What that means usually is the comp committee or the audit committee of your company's board, they formally approve the results and thus satisfy or confirm that the achievement of the performance metrics has been obtained. So on this slide, there's...
Go ahead. I just want to point out one error that I made on the slide. No one else made it except me. The target shares times shares, it's really the target shares times fair value. So that was just pointed out by a viewer. I apologize for my error. Cross out shares and write in fair value. And we'll revise that when we get the updated slides posted. Sorry, Bill. Keep going.
No problem. So on this slide, as you can see, the table shows different payouts. Notice our metric is net profit as opposed to stock price or what Mike had spoke about previously. And the payout can be anywhere from 0% to 150%. And based on where that payout percentage ends is basically the amount of expense that your company will record over that performance period / service period, however you define those two. Elizabeth, go back real quick.
Oh, sorry. Yep, going back.
So just to walk through just a quick example before we get to the next slide. If the payout is 75%, therefore your company had net profit of $10 billion to $12 billion. Holy cow, that's a lot of money. Then 75% of those target shares, and by target shares we mean shares can be granted at either a target amount, which is 100%, or shares can be granted at an amount greater than target. It can be maximum. Whatever the case may be, your comp committee will dictate what target shares are. But usually, in the world that we live in, target is usually 100% achieved, 100%. If the payout was 75%, that means 75,000 PSUs would be earned. Therefore, 75% times $1 million is $750,000 worth of expense to record. Likewise, if your payout is 150% or more, you'll generally max out at 150,000 PSUs or expense of $1.5 million. Now, as Mike pointed out previously, for the market-based awards, if the service requirement is met, but the target is not, you do not reverse the expense. In this case, for a performance-based award, if the performance metric itself is not met, you get to reverse the expense. That's a key difference in the accounting treatment for these awards. If someone leaves the company prior to that 1/1/2018 vest date, expense may be reversed. I have had situations where a client had a performance period that ended on 12/31, but their comp committee didn't approve the results until sometime in February for a calendar year-end company. And the question came up, if the participant was to leave between January 1st and that comp committee approval date, would they be entitled to the award? That is very subjective, and it depends on the terms of your award agreement. So be very careful.
It shouldn't be subjective. It should be in the award agreement. If the award agreement is silent, then you have a problem. But it shouldn't be subjective at all. It should be in your award agreement, very specifically spelled out. Let me just jump in with a few little questions here. Can you define target shares? Some people think you should expense at the maximum shares possible. Target shares, the example I think will help a little bit more when we get onto the sort of Bill walking us through the numbers on the next slide. But target shares mean the estimated probable payout shares at the end of this reporting period. So today is the end of my reporting period. I think 80% is going to get paid out. Then I need to be booking expense based on the service period that's elapsed times the 80%. It's not the maximum. It's absolutely not the unless you think the maximum is what's probable being paid out, then yes. But other than that, absolutely not. We have a couple more questions down here, Bill, sorry. On a performance base, can the fair value be less than the market value for a dividend-paying company that does not provide dividend equivalents on these awards? Absolutely, positively, yes. Just like with regular RSUs, if you pay dividends on your stock, but you don't pay dividends on your RSUs or your PSUs in this case, you get a discount for the amount off the fair value that you're not, it's not really the same thing, right? They're not getting the same benefits that common stockholders get, so the fair value can't be, well, it shouldn't be exactly equal to the market value on grant date. You're exactly right. Excellent point. And there's one more. Is the service end date 1/1/2018, or would it be the date the committee certifies? And again, that should be determined. Bill already spoke to it, and I think he answered your question, but that should be determined by the terms of the grant agreement. It should say, we're going to meet this goal, we're going to certify. You must stay employed through either this date or this date in order for your award to vest. It should be very explicit. If it's silent, then you have a problem.
And there may be a quick difference in terminology when you look at what's deemed vested, because you've already met the performance, or you think you've met the performance criteria, but your audit committee or your comp committee hasn't officially certified it.
Right.
So it may be considered vested from an expense perspective, but until the comp committee approves it, those shares won't get issued to the participant until that time. And then you might have an expense true-up. Again, this is all depending on how your plan is structured, but you could have an expense true-up between those first couple of months, just given the timing of when the approval is obtained, if that makes sense. Okay,
so here's our little example, which shows how variable these performance-based awards can be. Go ahead, Bill.
Yep. So in this example here, in Q1, the probable payout estimate, and that's something that management does every quarter, is preferred, if not more frequent than that, but usually quarterly is a good indicator. 75% of the award was deemed probable of being paid out. Therefore, you have 25% of the service period and 75% of a probable payout. You have $187,500 of expense in Q1. Then in Q2, things change. You reach some difficulties, and then your probable payout goes from 75% to 0. Well, now you, as Elizabeth mentioned, you do this cumulative true-up. So now you have basically no expense to record, but you recorded $187,500 last quarter. Now you have an expense credit going through your books to account for the true-up. And then in Q3, you're back to 100%. Now you're at $750,000. And then finally in Q4, which is ideally the final year of the performance, or the final period of the performance period, you're at 150%. Now you have to record $1.5 million in total expense. You recorded $750 in Q3. You record another $750 in Q4. You've now met the probable payout for this award. But as you can see, there is some volatility in the income statement when you do this.
Yeah, and note that the total expense was not $1 million as it started out. It ended up being 1.5 because your payout was 150. And with the market-based metrics, that's included, embedded in your fair value, so you wouldn't ever get more than 1.1, as I think was covered before.
Yeah.
Okay. We're going to head on to tax accounting. I don't see any other questions, but let's move on to tax accounting, everybody's favorite topic other than diluted EPS. All right, so tax accounting, here's our refresher, our high-level refresher. Your deferred tax asset, also known as your DTA, is booked for non-qualified stock grants. So ISOs and 423 qualified ESPPs don't get a DTA ever. They may get a tax benefit, but they never have a DTA because a DTA is an anticipation of a future tax deduction. And while you may get that for an ISO or an ESPP when you get a disqualifying disposition, you can't count on it. And the accounting literature specifically says you cannot book a deferred tax asset in anticipation for tax qualified awards. So what is your DTA? Under ASC 718, actually I won't say it's not really under 718, but under U.S. GAAP, not IFRS 2, which is completely different. It's simply your expense accrued, whatever you've booked for your expense, like Bill was talking about on the previous slide, times your applicable corporate tax rate. And for most companies, you're probably going to be booking a DTA in the U.S., maybe in the U.K. for U.K. grants, not too many other countries. It's usually a U.S. thing because you can count on your tax deduction. When you have some very complicated tax structures, that's not always true, but generally it's a U.S. thing for most of us. Okay, as those grants are settled, they're exercised, they're releases, non-qualified options expire, that DTA needs to be released or reversed because there's no longer any possibility of a future tax deduction. So you get that off the books. And just a little side point here at the bottom, if you're in net operating loss, NOL, most of the companies I've worked with don't book DTA, don't keep an eye on it, even though they maybe should. But in general, they should be booking a DTA, and then as they come out of it, they may try and recover from that and go back and figure out what their DTA should be, calculate it sort of the balance sheet way. But if they are booking a DTA and you're in net operating loss, it's offset by a full or partial valuation allowance, which is sort of like allowing for bad credit, if you've ever done the basic accounting classes, saying, well, we're going to get our credit cards paid, but it's only going to be paid 98% instead of the whole 100%. So something like that. All right, so that's your refresher. Sorry if that was too basic for 99% of you. I apologize. So Mike's going to take us through the accounting for performance grants. Mike?
Great, thanks. Yeah, my I guess favorite slide, especially with the picture. I can't believe there's not a smiley face on that pepper with the hat, but maybe we'll add it in before we send out the final deck. But right, so Elizabeth just finished giving a great refresher on the accrual of DTA, kind of in parallel to your expense, and how that DTA gets taken off the books, whether it's because of that taxable transaction that occurs or if shares were to expire. So let's take a closer look at the performance side. So we know with market-based and performance-based, the DTA is, of course, going to follow the expense, but we know, as we previously talked, the expense for the market-based doesn't fluctuate. You know, it's fixed at that locked position. And subsequently, with that market-based award, as those shares are released or canceled for that matter, ensure that the DTA matches the expense that you booked. And this could be especially tricky if for some reason you had like a partial release of PSUs or some weird deferral arrangement. Make sure that your expense is being allocated appropriately to those shares that have been transacted. And remember, because it's a market-based award, if you do end up getting a 0%, the expense stays, but we still have to get that DTA off the book somehow. We can't leverage a natural expensing forfeiture to piggyback off of. So it's treated just like an option expiration or like a vested cancel for when you have those market shares that aren't achieved. Obviously, with the performance-based, it's a little bit easier to follow along because you have your expense that's moving up and down, your DTA is getting marked up and down, and any of that sort of natural activity that occurs, whether it's a release or a cancel due to unmet criteria, all of that is going to naturally impact your expense and therefore kind of flow to the DTA side on a one-to-one basis. So just recognize that fact that if you're doing any sort of these DTA calculations manually, that with the market-based side, when those shares are not realized, even though you're kind of all done on the expensing side, you do still have to reverse that DTA the same way you would any type of vested cancel.
And real quick, Mike, if I can add, those of you who have been watching the FASB current developments, last year at this time they had released FASB ASU 2016-09, which was intended to simplify the tax accounting for stock-based comp. We aren't going to cover that in a whole lot of detail here, but just know when Mike and Elizabeth are talking about the DTAs being reversed or trued up upon cancellation or vesting, that normally goes to your income statement. It does not go to your APIC pool. So I just want to make sure. The APIC pool went
away, exactly. Yeah. And I actually think it does simplify in most cases, especially if you got rid of your forfeiture rate. But getting rid of the APIC pool is going to cause, and so we used to post our excess tax benefits and our tax deficiencies to our APIC pool. We'd increase it and we'd decrease it, and there's no APIC pool. It would hit in your income statement as tax expense, and now it's all going straight to your income statement, which will really increase your income statement volatility. But not tracking an APIC pool some of us would argue, at least the tax people who have had to try and do this, it is going to be a simplification. It's going to make life a little bit easier. All right. With that, we're going to move on to Bill talking about diluted earnings per share.
Oh, boy.
Woohoo!
This is going to be fun. So when it comes to diluted EPS, there are some rules of thumb that Elizabeth, Mike, and I wanted to make you all aware of regarding performance and or market-based awards. In the guidance, the performance awards, both performance and market-based, sorry, I'm not trying to repeat myself, they're considered contingently issuable shares, which all that means is they could be issued. So if you don't get anything else on this slide, please get this second bullet point. Do not include performance or market-based awards in your diluted EPS denominator until the performance or the market-based condition criteria is actually met. That is a little bit different than when you are expensing, because remember those words probable and improbable. If it's probable, you expense it. If it's improbable, you do not expense it. From an EPS perspective, you either meet the criteria or you don't. And the key point you want to remember is at the end of the reporting period, just ask yourself this question. Is the performance criteria met or not? It's a simple yes or no question. Being ahead of schedule or on pace to achieve the performance metric or the stock price target, whatever that case may be, that is not sufficient when it comes to including these shares in your EPS calculation. As Elizabeth mentioned, when there are conditions like IPOs or change of control events, a merger or an acquisition, you don't include any of that information until that triggering event actually happens. It has to happen first.
You're probably going to disclose something about how much is going to pay out if you go IPO, but yeah, you're not going to include it in your diluted, absolutely. And the other question I get about this all the time is, well, my end of the period's today, and my performance period isn't up for another, 9 months. So does that mean the goal's been met? Well, look at the goal. It doesn't matter what the date is. It doesn't matter what the performance period is. It's today. If my earnings per share target, let's say, was hit today, which would be unusual, but let's say my revenue target were hit today or my sales target were hit today, whatever the target is, if it were hit today, I don't care when your service period is up. Look at today. Was that performance metric met? Yes, then include them. And next quarter you might have a different story, right? Especially for things like relative TSR, which can go up and down and up and down. So you might include them this quarter and not include them next quarter. You have to reassess every quarter. Sorry, Bill. Keep going. We'll move on to the next slide.
Nope, no problem. So the most common EPS method that I help clients with is the Treasury stock method, which you can find under FASB ASC 260. Elizabeth, Mike, and I were talking about this last week on how we can best explain this without going into a whole lot of detail. So here's our attempt to do that. The Treasury stock method assumes all shares are issued at the end of the performance period. Basically, what's the worst case scenario if all those options or PSUs were vested and deemed issued? And then the Treasury stock method kind of softens the impact a little bit by assuming that the company could buy back some of those shares based on the 3 buckets you see here. We aren't talking about option exercises, but if there were any, you would include those proceeds. There's another bucket related to average unrecognized or unamortized compensation cost, and all that relates to is the future service for those grants that are still outstanding. And then the third bucket is the amount of excess tax benefits, which, as we just briefly discussed, ASU 2016-09 amended this guidance to basically remove this bucket. So think of Treasury stock method, worst case scenario, how many shares could the company buy back? And then the question is what's left? Any remaining shares could be considered dilutive, or if for whatever reason the company was able to buy back more than what was outstanding, those shares would then be considered anti-dilutive, which is what this table below is trying to articulate. So for Grant A, for example, was the performance criteria met? Yes. How many shares were considered outstanding? You had 100. How many could the company buy back based on those buckets? They could buy back 20. Therefore, 80 shares would be considered dilutive, and you would then add the 80 shares to your EPS denominator when doing diluted EPS. The other examples are fairly straightforward. Mike or Elizabeth, anything else I'm missing here?
No, I think that's great.
Oh, one thing, sorry, for Grant B. So Grant B, this particular award type, the performance criteria was not met, and there were 100 shares outstanding. And as you can see, no shares could be bought back. There was no dilutive impact because, remember what I was saying earlier, don't include performance awards or market-based awards in your EPS calc unless the performance criteria is met. Because the performance criteria was not met, these shares were not included. That doesn't mean that they're anti-dilutive. That just means they were not included, which is a disclosure requirement that you may have to, likely have to.
All right, and with that, we're going to move on to the next slide.
Is there a question?
We do have a question. That's the thing I was going to bring up. It says, how would the comp committee needing to certify impact EPS? And I'm not really sure what the asker means, but the comp committee probably wouldn't need to certify EPS, but some part of the company will need to certify if your goal were EPS, basic EPS, and I wouldn't think it would be based on diluted EPS. I've never seen that. But somebody needs to certify that the goal has been met, and it could be a comp committee, it could be a subcommittee, it could be your CFO, it's usually going to be more than your CFO, though. But somebody's got to certify not necessarily, what your shares outstanding are, although probably that too, but they've got to come up with and say, hey, your net income is X, and we believe that, and we sign off on that, and that's part of our financials before a goal would be paid out, I believe. All right, and we have one more question. Sorry? What if a quarter... Oh, sorry, go ahead.
I was just going to add, usually the audit committee certifies the financial results, and then they kind of pass that information on to the comp committee, which then they may make adjustments, they may not, but usually those figures are audited by the auditors and approved by the audit committee. And then the comp committee just rubber stamps it sometimes.
Okay, and the last question is, what if quarter end is 3/31 but they don't certify for 2 more weeks? If the goal has been met and you're relatively certain that it's going to be certified but they just haven't had the meeting, then generally I would consider that the goal has been met, and I would include those in my diluted EPS. If it's just a rubber stamp and all the work has been done, then yes, I would include them. If the rubber stamp is not really a rubber stamp, but there's work that needs to be done to prove out the number, then I wouldn't include them. But feel free to correct me if you've seen it otherwise, Bill. Or Mike.
No, that's usually you have to be pretty certain, and that's where you get input from your management team. If your board is very particular on having things approved by the comp committee before you disclose, I would follow that precedent. But from an accounting standpoint, be conservative and be certain, because once you disclose it, you don't want to have to go back and disclose something different.
All right, and we're going to move on to, speaking of the devil, disclosures. All right, and we're going to go a little bit quickly through this, and I apologize in advance. We're a little bit behind, but a lot of these are just examples that I wanted to show, or parts of the standard we don't need to go through in great detail. Just nice for you to have as reference, and you can say, oh, it's here. Look, it's in this part of the standard. So the main thing for me about disclosures, and not all companies do this, but I think it's important. So this is Elizabeth's opinion, and I will support my opinion with some standard references in a moment, is that it really is important to disclose performance awards separately from time-based awards. They are very different creatures. They have very different payouts. They have they may not have very different fair values, but certainly a Monte Carlo is going to give you a very different result. And if you were averaging in your Monte Carlo fair value with everything else, to me that makes absolutely no sense. So, and then those required disclosures will differ based on the underlying award type. In this case, for this presentation, we're going to focus on RSU or PSU disclosures, what's required. But I do really think it's important to separate those out. And here is my support. 718.10-50-2G, an entity blah, 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 shall provide the information specified in the stuff above separately for different types of awards to the extent that the differences in the characteristics make it important to an understanding of the use of share-based comp. And then it could also be important to segregate number of options or units not exercisable based on service conditions and those which do performance conditions. So it definitely does give examples and call out that sorry, I got distracted by an alert that popped up in my face that we're ending in 5 minutes. Sorry, that they should be separate when possible, when it makes a difference. So let's see. We had a question come in. Let's see. Question, we will not include the market condition or performance condition PSUs even though we're expensing the grant based on the probability. Do we still exclude them from diluted EPS? Yes, and that's the disconnect, right? It's a complete disconnect between expense and what's in your diluted EPS. So you will exclude them until the goal has been met. If your sales target is $100 million and you're at $99.9 million and you're only in the first quarter, you still haven't met the goal. So you still exclude them. Even if it looks really, really good, there's no possible way you can miss it. If you haven't met the goal, exclude them. Sorry, and I'm jumping ahead. I just want to get through a few of these disclosures. So these are the disclosures. I get this question a lot. These are disclosures up top for share options. So outstanding at the beginning, outstanding at the end, exercised during, canceled during the year, etc. And then these ones down below, these are for things that were not included in C1. All right, and that includes vested. So we want to make sure to not include vested options, not to include exercise. The vesting is important for the RSU or for the PSU because that's the payout. That's the economic impact. So that's a quick slide. We don't have to spend any time on that. Here's the example from the standard of what your disclosures for PSUs or RSUs or RSAs should look like, right? Non-vested, which means outstanding. And I love how the standard calls RSUs or RSAs non-vested shares. What's been granted, what's been vested, what's been forfeited, and what's outstanding at the end of the period, and with a weighted average grant date fair value for each of those. So then I went out and tried to find disclosures, either good or bad, and most of these are good, I think, samples from companies, from recent 10Ks for companies. And they're nice and recent. Some of them are very recent. I found Macys on 1/28/17. They've got a very nice disclosure here. I really like the way they did this because they had the outstanding at the beginning of the year. Then they had granted that was performance-based. Then they had this, I get a lot of questions on this too, this performance adjustment. What do I do with the shares, the extra shares that I paid out? How do I reflect that in my roll forward? It doesn't give me a bucket for that. Where do I put it? Do I put it in granted? But I really like what they did here. They did a performance adjustment. In this case, it was a downward adjustment, but it's very clear what's going on, or at least I think it is. And then they have granted, time-based, separate. They did lump together forfeited and vested, and I think that's okay. But it really does break things down, and it gives us all the required disclosures. It does a nice little adjustment in there to deal with those extra shares or those canceled shares for reasons other than a forfeiture. But I think it does a really nice breakdown.
Yeah, and it's very important to, if you can make it very clear what that performance adjustment shares are, it'll make things like a forfeiture analysis that you're doing for those companies that are still using estimated forfeitures, and making sure you can isolate your proper forfeiture activity from perhaps, like we can see here, cancellations, unvested cancellations by way of a missed performance factor. So again, nice job of Macys to isolate those and itemize them as they did.
And we have some more questions coming in. I'm going to hold the questions till the end so we can get through the slides quickly. I'll go quickly, I promise. Here's another, and hopefully we can get to all the questions. If we don't get to your question, we will follow up with you after the webcast to get your question answered. I apologize. All right, so here's another sample. This is from TJ Maxx, or the parent company for TJ Maxx. They are doing all their disclosures for PSUs separately. This is just PSUs. This is what do we do with our PSUs? What was outstanding, what got granted, what got vested, what got forfeited. And now they may have had a performance adjustment. They may have lumped it in with granted. That's something else that I see very frequently. When do those shares get granted for purposes of disclosure? My personal opinion is you can put them, I like the way the performance adjustment was done by Macys. That makes perfect sense to me. Or you could put them in granted in the period in which they are paid out, because in essence there are extra shares being granted. I think either approach is okay as long as you're consistent. Don't flip-flop your methodology from period to period. And then I had a little sample language here from vesting on an IPO. I'm not going to read it out, but remember, especially when you've got a lot of RSUs or PSUs outstanding and there's some criteria, you're going to be disclosing them whether or not you have, whether or not they're included in your diluted EPS, whether or not they're contributing to your expense, because in this case they're not. but they did a lot of disclosures talking about what's going to happen, what the impact could be, what the expense impact would be had the IPO occurred. Okay, with that, Shauna, do you want me to try and address the extra questions, or do you want to wrap it up and we can follow up after?
Sure. I'm going to go ahead and wrap this up since we are approaching the 12 o'clock hour. Thank you so much, Elizabeth, Bill, and Michael, who joined us, and thank all of you for attending today's educational webcast. We will go ahead and send out the answers to the questions and contact you in the coming day, and also links to the recording and materials for you to go ahead and share. Thanks so much, and have a great day. Bye-bye.